$8. That is the gap right now between what silver costs on paper in New York and what buyers in Shanghai are actually paying for physical metal today. $8 per ounce. And if you are sitting at home holding silver, in a stack, in an ETF, in an IRA, or a SIPP, that number is the most important thing happening in these markets this weekend, and most people have no idea it exists. Hold on to that thought, because in about 8 minutes, I am going to show you a second number that makes the $8 gap look like the mild part of this story. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where these decisions get made. I have watched what happens when retail investors get the wrong information at the wrong time. That is why I am here, and that is what Currency Insider is built on. Calm, data-first analysis. No hype, no sponsored content, no agenda. Everything I show you today comes from publicly available sources, and I will name every single one as we go. Today you are going to understand exactly what the Shanghai Premium means and why it matters to you personally. You are going to understand what the COMEX coverage ratio is, what 13.6% actually signals, and why that number has historically preceded some of the most significant moves in this market. And you are going to walk away with one specific thing to watch this coming week that will tell you a great deal about where this goes next. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Before any of that, last week I told you to watch the US dollar index at the 101.50 level. I said if DXY broke and held below 101.50, it would remove one of the main headwinds pressing down on COMEX silver prices. As of Friday's close, DXY printed 100.50. That level broke. The dollar is now sitting at its weakest point in weeks, and silver still closed at 84.44, which tells you something important about the other forces in play right now, and that is exactly what this video is about. Let me set the scene for where we actually are. As of Friday, March 13, 2026, silver spot closed at $84.44 per ounce on Western markets. That is according to USA Gold's closing data. 3 weeks ago, silver was trading in the high 70s. If you are holding physical silver, you have felt every dollar of that move. Gold is elevated. The macro backdrop is tense. The U.S. 10-year Treasury yield moved to 4.27% on Friday according to Trading Economics, hovering near 4-week highs. The Iran conflict escalated again this week. The Defense Secretary reported the largest wave of strikes yet. The U.S. dollar index closed at 150, according to Yahoo Finance. Now here is the thing that should be getting more attention than it is. A firm dollar historically pushes COMEX silver prices lower. The dollar has been relatively firm, and yet the Shanghai Premium on physical silver has not closed. It has widened. That tells you that what is driving physical demand in China right now has nothing to do with currency-adjusted arbitrage. Chinese buyers are paying for metal. Full stop. Drop a comment right now. I genuinely want to know. Are you currently holding physical silver, ETF silver, or mining exposure, or some combination? The comment section here works as a real-time sentiment tracker, and I read every single one. Now let me show you the number that stopped me cold when I pulled up the CME warehouse data this week. COMEX registered silver, that is the portion of warehouse inventory that is immediately deliverable against futures contracts, has declined 22.1% over the past 30 days. 22.1%, and within that, 22.4 million ounces have been physically withdrawn. The coverage ratio, that is the percentage of registered silver available against total open interest, now stands at 13.6%. When I looked at that number, I want to be honest with you, I had to look at it twice. Because in 15 years watching commodity markets, a coverage ratio below 15% is not something you see often. It is historically associated with delivery squeeze conditions. Think of it this way. Imagine a theater that sells tickets to 1,000 people, but only has 300 seats physically available on the night. Most ticket holders never actually show up for the seat. They trade their ticket or cash it out before the show. The system works fine as long as the ratio between tickets and seats stays within a reasonable range. The moment a higher than expected percentage of ticket holders decide they want their actual seat, the theater has a problem. That is roughly the dynamic unfolding in COMEX silver right now. The most recent warehouse report shows 103 million ounces of registered silver available against 429 million ounces of total open interest. That is approximately 24% coverage of outstanding contracts according to Discovery Alert's analysis of CME data. The paper market is operating on leverage ratios that have no real historical precedent during a period of simultaneous physical demand pressure from both industrial and investment channels at the same time. And here is the part that most channels are not connecting properly. This is not happening in isolation. It is happening at exactly the same moment that Shanghai is paying a premium of between $4 and $8 per ounce above the COMEX referenced price. The Shanghai Gold Exchange's AG T+D contract, which is a physically settled instrument meaning it requires actual metal delivery, has been trading silver north of $88 to $92 per ounce, according to SD Bullion's tracking of Shanghai exchange data. That is a 5 to 10% premium above Western spot. If you know someone who has been watching silver this week and trying to make sense of these moves, share this video with them right now. This breakdown took real time to put together, and the people who need it most are probably not searching for it. Now, before we run too far with the Shanghai number, I want to be genuinely fair to both sides of this story. Shanghai premiums can reflect local taxes, financing costs, and domestic market structure, not purely physical scarcity. That is a legitimate caveat, and I am not going to pretend it is not. What makes this situation different is the context around it. China officially reclassified silver as a strategic material and introduced restrictions on exports according to TradingKey's market analysis. That is not a temporary local pricing quirk. That is a structural realignment of where price discovery happens. And increasingly, not completely, but increasingly, that is Shanghai, not New York. Think of it like this. For decades, the COMEX price was like the national menu price at a major supermarket chain. Shanghai was the corner shop that charged a small local premium. What we are watching now looks more like the corner shop has started buying directly from the supplier, and the supermarket chain is discovering that its warehouse is emptier than its menu board suggested. Stop. Before we go any further, I want to show you something that actually supports the bearish case here, because I think it is genuinely important, and I would be doing you a disservice if I left it out. COMEX has eligible silver, that is metal sitting in approved warehouses that is not yet registered for delivery but could be converted. If holders of eligible inventory rapidly convert to registered status, deliverable supply gets temporarily flooded. That has happened before. It is one of the release valves the system has. In the bearish scenario, that conversion happens fast enough to absorb the withdrawal pressure. The DXY rallies above 103 on Iran-related dollar strength. Macro risk-off sentiment hits silver's industrial demand narrative, and the paper price compresses back towards $78 to $80 despite the physical tightness. That is a real possibility. I am not dismissing it. What I am saying is that the structural pressure now requires that release valve to actually fire, and fire at scale, to prevent a repricing event. A question for the analytical minds in this community: when you look at the combination of a 13.6% COMEX coverage ratio and a persistent Shanghai premium above 5%, which factor do you think carries more weight as a leading indicator? Drop your answer below. Let me bring in the bigger picture, because the macro context here is not incidental. It is load-bearing. The Iran conflict escalation this week is not just a geopolitical headline. The Strait of Hormuz carries a significant share of global energy flows, and any disruption there triggers immediate dollar safe haven demand on one hand and a commodity scarcity bid on the other. Silver sits in an unusual position because it is both. It has industrial demand exposure, which suffers in genuine risk-off conditions, and it has monetary demand exposure, which benefits from dollar uncertainty. The World Gold Council's data on central bank reserve allocation is worth referencing here. Central banks added to gold reserves meaningfully in 2024, and the early data for 2025 showed that trend continuing. These are not traders checking price charts every morning. When a central bank reallocates reserves into gold, that is a multi-year institutional decision. The direction of that travel is documented, and it is not reversing. I am not saying the dollar collapses next Tuesday. What I am saying is that the Congressional Budget Office's own fiscal projections make the math increasingly difficult to ignore, and the Bank of England's own reserve data shows that UK institutional positioning in gold has followed a similar directional trend to what we are seeing from central banks globally. De-dollarization is a decade-long structural process. It is not a Tuesday event. But the direction of travel is visible, and it is documented. For UK viewers specifically, the LBMA, the London Bullion Market Association, which is the primary benchmark for gold and silver pricing in European markets, has been reporting elevated vault withdrawal activity. That is worth watching alongside the COMEX data because it suggests the physical tightness is not purely a Shanghai phenomenon. On the industrial side, and this matters because silver is not just a monetary metal. The Silver Institute's demand data shows industrial consumption has been running at elevated levels, driven by solar panel manufacturing, AI hardware production, and medical device demand. Silver is not like oil where you can watch it burning. It is hidden inside electronics, solar cells, connectors, and medical devices, dispersed in tiny amounts across massive global industries. The North Sea energy transition and UK solar rollout are adding to that demand picture from the British side. I am not going to give you a precise ounce per megawatt figure because that would be false precision and you deserve better than that. What the Silver Institute's data shows is the direction of demand, and that direction has not reversed. If you have stayed with me this far, what is coming in the next few minutes is the part that actually changes how you read these markets going forward. The three lanes framework, my one specific call for this week, and an honest look at both sides of where this goes next. All right. Let me show you how I am actually thinking about this week using the three lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. COMEX futures positioning shows a coverage ratio of 13.6% registered silver against open interest. That is stress territory by any historical measure. The CME warehouse report dated this week confirms 103 million ounces registered against 429 million ounces open interest. Lane 2, the physical market. Shanghai Ag T+D premiums of $4 to $8 per ounce above Western spot, confirmed by SD Bullion's tracking of Shanghai exchange data as of Friday, March 13th. COMEX withdrawals of 22.4 million ounces in 30 days. That is not traders repositioning. That is physical metal leaving the building. Lane 3, macro. Dollar index at 150. 10-year yield at 4.27%. Iran conflict actively escalating with weekend gap risk on Monday's open. Central bank gold buying trend intact per World Gold Council data. In 15 years watching currency and commodity markets, the times I have seen all three lanes applying simultaneous directional pressure, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying the setup is worth understanding clearly. When the paper lane is showing stress level coverage ratios, the physical lane is showing active withdrawal and an $8 cross-market premium, and macro is pointing toward both dollar uncertainty and geopolitical commodity pressure. The historical pattern in precious metals has been that one of two things happens. Either the release valve fires fast enough to relieve the pressure, or the pricing system reprices to close the gap. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing, the May COMEX silver contract. Specifically whether institutional long holders stand for delivery when that contract moves into its delivery window. If we see a significant increase in delivery notices against the May contract, that data comes from the CME's daily delivery notice reports. That is the signal that paper long holders are converting to physical demand inside the COMEX system itself. That is the pressure point. If delivery notices come in elevated and registered inventory continues to drain, that is when the spread between Shanghai and New York becomes impossible to arbitrage away quietly. If delivery notices stay low and eligible to registered conversions pick up pace, the pressure valve is working and the repricing event gets deferred. Watch the CME daily delivery notices this coming week. That is where the real information will be. This is my one call for the week. John, FX Insider. On record. I will be back next video to tell you exactly what happened. No edits. No excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. COMEX registered inventory continues to drain below 90 million ounces. Eligible to registered conversions stall. The Shanghai premium widens past $10 per ounce. Institutional holders with long positions stand for delivery at the May contract. That sequence forces a paper physical spread repricing event that pushes silver toward the $95 to $100 range. Here is what needs to happen for the cautious picture instead. COMEX eligible inventory owners rapidly convert to registered status and temporarily flood deliverable supply. The DXY rallies back above 103 on Iran-related dollar strength. Macro risk-off sentiment hits silver's industrial demand story. The paper price compresses back towards $78 to $80 despite the ongoing physical tightness. Both are genuinely possible right now. The weekend gap risk heading into Monday's open is real, If there is any escalation at the Strait of Hormuz over the weekend, silver will gap at Monday's open and the Shanghai premium could surge before Western markets can respond. Your job is not to pick one scenario and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, are you currently holding physical silver? And if so, are you seeing elevated premiums at your local dealer right now, or has it normalized? Second, looking at what we covered today, do you think the eligible to registered conversion valve fires fast enough to prevent a May delivery squeeze? Or do you think this time the math does not work out quietly? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going into the May contract delivery mechanics in detail. I will show you exactly how to read CME daily delivery notices in real time, and that is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.